Right now, there is a retired couple somewhere in America doing what they were told to do their entire lives. They are not gambling. They are not hiding money. They are not trying to cheat the IRS. They are sitting at a kitchen table with a yellow legal pad, a checkbook, a cup of coffee, and a checking account balance that makes them feel safe. Maybe it is $18,000. Maybe it is $27,000. Maybe it is $42,000 because the roof is getting old, the car has 146,000 miles on it, and Medicare does not cover every surprise life throws at you. And they think that money is just sitting there quietly, waiting to protect them. But here's what nobody at the bank explains when they smile and call you a valued customer. That checking account is not just a storage box, it is a monitored financial window. Every deposit, every withdrawal, every sudden change in pattern, every cash movement above a certain line, every transfer from your pension, your Social Security, your RMD, your Venmo, your PayPal, your adult child, your old savings account, it all creates a picture. And in 2026, that picture is no longer being read only by the friendly teller who knows your first name. It is being read by software. It is being read by bank compliance systems. It can be reported to FinCEN. It can be cross-checked later against tax forms. And if that picture looks messy, even when every dollar is completely legal, you can find yourself spending months trying to prove something that should have been obvious from the beginning. That you're not a criminal, you are just retired. My name is Joseph. This is Joseph the Investor. And if you are over 50, over 60, retired, close to retirement, helping a parent, or sitting on a paid-off house with cash in the bank because you were raised to be careful, you need to stay with me, because this one mistake is costing retirees thousands of dollars without them understanding why. And let me be clear right at the beginning, because this is where bad information spreads fast. There is no law that says you are not allowed to have more than $10,000 in a checking account. There is no IRS agent automatically assigned to your name because your balance crossed a line on Tuesday morning. That is not how the trap works. The trap is more subtle than that. The trap is that $10,000 is the number connected to cash reporting, the number connected to bank compliance attention, the number that makes people panic, and the number that causes retirees to make the exact wrong move. The mistake is not having legal money. The mistake is keeping too much operational cash in the wrong place, letting it earn almost nothing, letting it create unnecessary reporting noise, letting it sit above insurance limits in some cases, and then reacting to the rules in a way that makes clean money look suspicious. That is how good people get dragged into bad paperwork. Let me show you how this actually happens. Picture a man named Harold, 72 years old, retired from the county road department in Pennsylvania. His wife Denise is 69. They did not get rich from stock options. They did not inherit oil money. They saved slowly. Harold has Social Security. Denise has Social Security. Harold has a small pension. They have a traditional IRA from an old 457 plan, and every December, because some advisor told them years ago to keep things simple, Harold takes one big retirement distribution and drops it into the checking account. This year, it is $24,000. At the same time, they sold a used pickup truck for $11,800 in cash to a neighbor's nephew. Harold walks into the bank with the cash because that is what honest people do. He deposits it. A report gets filed because cash over $10,000 in a single day triggers a currency transaction report. That report does not mean Harold did anything wrong. It is routine. Millions of those reports are filed. But Harold does not know that. A teller says something vague about paperwork. Harold goes home nervous, and 2 days later, he makes the worst decision possible. He tells Denise, "Next time, we will just deposit $5,000 one day and $5,000 another day so nobody bothers us." Stop right there. That sentence is where the trap opens. Breaking up cash deposits to avoid the $10,000 report is called structuring, and structuring can be treated as a federal crime even if the money is perfectly legal. That is the part nobody explains clearly enough to seniors. The report itself is not the danger. The panic response is the danger. The legal money is not the problem. The pattern you create trying to stay invisible is the problem. So the first rule for retirees is brutally simple. If you have legitimate cash, deposit it honestly. Deposit it once, keep the bill of sale, keep the inheritance paperwork, keep the withdrawal receipt, keep the note explaining where the money came from, and do not play games with the number. The system is much harder on people who look like they are avoiding the rules than on people who simply trigger routine paperwork and have records. But cash reporting is only the first blade. The second blade is your normal bank pattern. Banks are not just looking at one big transaction anymore. They are looking at behavior. If you normally keep $4,000 in checking and suddenly you keep $38,000 for 4 months, that is a change. If your Social Security arrives on the 3rd, your pension arrives on the 1st, your RMD lands in December, your grandson sends you 3 Zelle payments for car insurance, your daughter reimburses you through PayPal for a family trip, and then you write a $15,000 check to a contractor, the software does not see Grandpa managing normal life. The software sees activity. In many cases, nothing happens. In many cases, nobody cares. But the problem for retirees is not that every flag becomes an audit. The problem is that the more cluttered your checking account becomes, the harder it is to explain your life in clean lines if anyone ever asks. And retirees have the messiest clean money in America. Think about it. A 35-year-old employee usually has 1 paycheck and 1 rent payment. A retiree might have Social Security, pension income, IRA distributions, brokerage dividends, CD interest, Medicare premiums, property tax payments, gifts to grandchildren, reimbursements from adult children, medical bills, insurance claims, funeral expenses, and random transfers between old accounts. Nothing illegal, nothing dramatic. But on paper, it can look like a junk drawer with a routing number. That is why the old advice, just keep plenty of cash in checking, is outdated. It was written for an era when your checking account was a convenience tool. In 2026, your checking account is a data trail, and the cleaner that trail is, the safer you are. Now let us talk about the money you are losing while all of this is happening. Because even if you never trigger a report, never get a letter, never talk to a compliance officer, the bank is still quietly taking advantage of your caution. Most regular checking accounts pay almost nothing. Many traditional savings accounts pay a rate so low it feels like a rounding error. Meanwhile, prices keep moving. Property taxes go up. Home insurance goes up. Medicare premiums go up. Car repairs go up. Groceries do not politely freeze because you retired. So when you keep $30,000, $50,000, or $80,000 sitting in a basic checking account because it makes you feel safe, that money is not resting. It is shrinking. Let me do the math in plain English. If a retired couple keeps $50,000 sitting in ordinary checking and earns almost nothing on it, while safer cash alternatives are paying meaningful interest, that couple can easily give up $1,500 to $2,000 a year in lost earnings. Over 5 years, that is $7,500 to $10,000. Over 10 years, that is a used car. That is dental work. That is a year of Medicare supplement premiums. That is the new furnace. That is not imaginary Wall Street money. That is household money. That is money retirees are losing because the bank trained them to confuse convenience with safety. Your checking account should be a wallet, not a vault. You carry enough in your wallet to live your life. You do not carry your life savings in your wallet. Checking should pay bills, receive predictable income, and handle monthly spending. It should not be the place where your emergency fund, your tax reserve, your future roof money, your grandchild gift money, and your long-term cash all sit in one big pile waiting to be misunderstood. So here's the number I want you to remember. For most retirees, the operating checking balance should be about 1 to 2 months of normal expenses plus a small buffer. If your monthly expenses are $4,000, that means maybe $6,000 to $10,000 in checking depending on your comfort level and bill timing. If your expenses are $6,000, maybe $9,000 to $14,000. But when you're consistently sitting at $25,000, $35,000, $50,000 in checking with no immediate purpose, you are not being safer. You're being inefficient. Your emergency fund, the true 3 to 6 month cushion, can sit in a high-yield savings account, a money market deposit account, treasury bills, brokered CDs, or a money market fund depending on your situation. The point is not to hide money. Do not hide money. The point is to separate money by purpose so your financial life becomes clean, explainable, insured, and productive. Bucket 1 is checking. That is your operating wallet. Social Security comes in, pension comes in, bills go out, groceries, utilities, insurance, property taxes if you pay monthly or quarterly. Keep it clean. Bucket 2 is emergency cash. That money needs to be liquid, but it does not need to sit in the same checking account where every debit card swipe and pharmacy charge happens. Put it somewhere insured, accessible, and earning something. Bucket 3 is planned spending. If you know the roof is coming, if the property tax bill is coming, if the car replacement is coming, create a separate savings bucket or account for that purpose. Bucket 4 is longer-term conservative money. That might be treasury bills, CDs, laddered across banks, or other conservative instruments that do not belong in checking at all. The cleaner your buckets are, the less your checking account looks like a tornado hit it. Now let us address the $250,000 line, because this one is not about IRS attention. This one is about protection. FDIC insurance is not magic unlimited protection. The standard coverage is $250,000 per depositor, per insured bank, per ownership category. That phrase matters. Per depositor, per bank, per ownership category. If a widow sells a house, deposits $420,000 into one savings account at one bank, and leaves it there for 6 months while she figures out what to do next, she may have a large portion of that money above the standard insurance limit, depending on the account structure. People think this cannot matter because banks are safe until suddenly a bank fails and everyone starts Googling FDIC rules at midnight. Staying insured is not hard, but it has to be done intentionally. Spread large deposits across banks or ownership categories. Use FDIC tools. Ask the bank to show you in writing how your coverage is calculated. Do not accept "you should be fine" from a teller who will not be the one reimbursing you if something goes wrong. Now here is where families accidentally create the next problem. A lot of retirees hear all of this and think, "Fine, I will add my daughter to the checking account so she can help if something happens." That sounds loving. It sounds practical. It can be a disaster. When you add an adult child as joint owner, you may be giving that child legal ownership rights over the account. If that child goes through a divorce, has a lawsuit, owes back taxes, gets into debt, files bankruptcy, or simply has a falling out with siblings after you die, your money can become part of their problems. And the joint account can override your will. You may think your 3 children will split the money equally, but the one child on the joint account may receive it automatically. That is how families explode after funerals. The cleaner alternative in many simple cases is a payable on death designation, sometimes called POD. You stay the owner while alive. The child has no access while you are alive. Creditors of the child generally cannot touch it while you are alive. When you pass, the money transfers directly to the named beneficiary outside probate. Is it right for every situation? No. You still need state-specific advice. But for many retirees, POD does what they thought joint ownership did without handing over control too early. Now let us talk about IRS letters, because this is what scares people the most. The IRS is not sitting there angry because you kept $18,000 in checking. The IRS cares when the numbers reported to them do not match the story on your tax return. That means if you receive taxable IRA distributions, report them. If you receive interest, report it. If you sell items online as a business and payment platforms issue tax forms, do not ignore them. If you get a family gift above the annual exclusion amount, understand who may need to file a gift tax return. For 2026, the annual gift tax exclusion is $19,000 per recipient. That does not mean you owe gift tax the moment you cross it. It usually means reporting may be required and it may reduce lifetime exemption. But if you are sloppy with records, a harmless family transfer can become a confusing tax question later. Same thing with digital payments. The 1099K threshold has moved around so much in recent years that many retirees are confused, and confusion is expensive. Under current rules, the broad federal reporting threshold is back to more than $20,000 and more than 200 transactions for goods and services. But platforms may still send forms in some cases, and states may have their own rules. The solution is boring and powerful. Separate personal reimbursements from business or selling activity, keep notes, keep screenshots, and do not run random family money through the same account where your retirement income lands if you can avoid it. Clean records beat memory every time. Let me give you the actual action plan. Step 1. Tonight, log into your checking account and look at your average balance over the last 90 days. Not today's balance, the average. If it is consistently above 1 to 2 months of expenses plus a buffer, ask why. If there is no immediate purpose, that extra money needs a job somewhere else. Step 2. Identify any cash deposits or withdrawals above $10,000 in the last year. Do not panic. Just make sure you have documentation. Bill of sale, inheritance letter, withdrawal receipt, settlement statement, whatever proves the source. Step 3. Do not ever break up cash transactions to avoid a report. That is the line you do not cross. Honest money deposited honestly with records is boring. Honest money chopped into suspicious-looking pieces becomes a problem. Step 4. Check FDIC coverage. If you have more than $250,000 at one bank, do not guess. Verify coverage by ownership category and spread money if needed. Step 5. Move excess cash into buckets. High-yield savings for emergency reserves. Treasury bills or CDs for planned cash. Money market options for liquidity. Always making sure you understand insurance, risk, and access. Step 6. Review beneficiaries and POD designations. Do not add adult children as joint owners just because someone at the branch said it is easier. Easier is not the same as safer. Step 7. Sit down with a fee-only fiduciary advisor or CPA who understands retirement cash flow, not a salesperson looking to roll your money into something complicated. Pay for 1 hour of clarity before you pay for 3 years of confusion. And if you are married, do this together. If one spouse handles all the money, the other spouse needs the map now, not after the funeral. Write down where accounts are, what each account is for, who the beneficiary is, what bills come out, and which money should never be touched unless there is an emergency. The worst time to learn the family financial system is the week after a death certificate arrives. Here is the bottom line. The checking account limit retirees need to worry about is not a single law that says you are bad for having money. It is a practical line where your checking account stops being useful and starts creating exposure. Too much cash in one checking account creates reporting anxiety, inflation loss, low interest, FDIC questions, messy tax records, family transfer confusion, and bad decisions. The government will not call you and explain that. Your bank will not call you and say you could earn more somewhere else. The IRS will not send you a friendly reminder that your records are messy before they send a letter asking questions. The system rewards retirees who are organized before there is a problem. It punishes retirees who try to explain 5 years of random transfers from memory. So tell me in the comments, how much do you normally keep in checking? Not the exact number if you're uncomfortable, just the range. Under $10,000, $10,000 to $25,000, $25,000 to $50,000, or over $50,000. And tell me your state, because bank habits, tax rules, and retirement costs hit differently depending on where you live. I read those comments because they tell me where people are getting trapped. And if this video made you think of your mother, your father, your spouse, your neighbor from church, or that retired friend who keeps everything in one account because the branch manager is nice to him, send this to them today. Not because they are doing anything wrong, but because they may be one messy account away from losing thousands quietly. Like this video, subscribe to Joseph the Investor, and turn on notifications because we are building a survival library for Americans over 50 who work too hard to lose money to rules nobody bothered to explain. Your checking account should serve you. It should not monitor you, shrink your money, confuse your taxes, expose your family, or hold your retirement hostage. Keep the wallet, move the vault, keep records, stay insured, stay clean. And never let a bank's silence become the most expensive advice you ever accepted.